As a beginner broker navigating the world of investment real estate financing, understanding hard money loans is essential for providing guidance to your clients. This video will equip you with the knowledge needed to effectively assist borrowers seeking hard money loans for their investment project. Hi, I'm Ian and I own Grafton Funding. We are a specialist lender in the investment real estate financing space. So first, you need to understand what a hard money loan is. A hard money loan is a short-term, interest-only bridge loan with no prepayment penalty on investment real estate, where the lender is accepting the subject property as collateral against their loan. The term hard money comes from the fact that the lender is accepting a hard asset as collateral. Hard money loans come from private lenders or private equity groups as opposed to conventional banks. So because of this, loan terms can differ greatly from lender to lender. Hard money loans have developed a bad reputation in some circles, mainly due to unscrupulous lenders. So investors that are not really familiar with how they work and what they should cost can sometimes be wary of using them, even though the reality is hard money loans are an amazing product for real estate investors. When do you use hard money loans? Hard money loans are most commonly used for fix and flip projects or fix to rent projects. Real estate investors can get the capital they need to purchase and then rehab and then either refinance or sell the investment property. They can also be used when a property is what we call unstabilized, which just means that the rents are not high enough to qualify the property for a long-term mortgage. If the rents are too low, then the only lending option is for the borrower to use a hard money loan to acquire the property, to do the rehab work, and get the rents high enough so that the property will qualify for a long-term mortgage. Hard money loans can also be used for time-sensitive purchases. Most hard money loans can be closed relatively quickly, sometimes within a few days. So if a DSCR lender or a conventional lender can't move that fast, which they can't, then a hard money loan can be used to bridge that gap so the borrower can still acquire the property in the short time frame that they need. And lastly, another way you can use hard money loans is for borrowers that are financially or credit challenged. Investors that have inconsistent income or not so great credit will find hard money lenders more willing to work with them than a conventional lender would. So here are some key features of hard money loans. They're short term, so typically hard money loans have a duration of 6 months to 2 years. They come with quick approval, so hard money lenders can approve faster and close faster and fund faster than traditional lenders can. They are asset-based, so the property's current value and future value are the most important factors considered when deciding on approval. Higher interest rates, so hard money loans do generally cost a bit more. They're a bit more expensive than conventional loans. As a broker, if you work with legitimate, honest, and trustworthy hard money lenders, then hard money loans can actually be relatively cheap. They come with flexible terms. So hard money lenders will generally be more flexible on loan terms, depending on the borrower and the property. They can generally underwrite loans more on a case-by-case basis than the more strict and rigid guidelines and rules that conventional lenders are going to have. Loans can provide funding for both the purchase and the rehab of the property. The portion of the loan going toward the purchase of the property is paid out at closing, and then the portion of the loan for the rehab is held back. And that's paid out in what we call draws throughout the course of the project. So the borrower needs to pay for their rehab money up front in stages and then submit for reimbursements from the allocation that the lender has held to the side. And then, of course, once the rehab work is complete, the borrower either sells the property or refinances the property and the hard money loan is paid back. So brokers who familiarize themselves and really understand the key features of hard money loans can really effectively help their clients secure the financing that they need for their investment properties. This knowledge not only means that brokers are offering sound advice, but it also establishes them as experts and as knowledgeable professionals in their industry. Now, the amount of money that you get from a hard money loan is dependent on a few factors. So the property's current value, property's potential future value, the geographical location of the property, the borrower's credit score, although that's not too important, and the borrower's prior experience with rehabbing or stabilizing property. And then, of course, as we talked about, a lot of the time it's a case-by-case basis. So sometimes the terms are just based on a lender's hunch. Loan amounts are based on loan-to-value percentages, so LTVs, and they're determined by the lender. So each lender will have different maximum LTVs that they will allow on the purchase price, the rehab cost, and what we call the ARV, the after repair value. LTVs for hard money loans are typically higher than they would be for conventional mortgages on investment property. Some lenders even offer 100% financing, so 100% of the purchase price and 100% of the rehab cost, although that is pretty rare and the borrower would need to be a very experienced borrower usually to qualify for that type of financing. Usually a borrower will need to put in at least 10% of their own money plus closing costs and loan fees. So for an example, if a borrower is purchasing property for $200,000 and they feel that they need to spend $30,000 to get the property to the point where it's worth $300,000, a hard money loan would look something like $180,000 loan against the purchase price. So the borrower is putting down $20,000 plus a loan for $30,000 of the rehab. So all of the rehab funds. So that's a total loan of $210,000 against the cost of $230,000. So what are the pros of hard money loans? So we have quick access to funds. So fast approval and fast fundings means that borrowers can acquire time-sensitive opportunities. There's less stringent qualifications. So approval is based primarily on the property itself and its value and its future value. So more investors can qualify than would qualify for conventional loans. Now, of course, if there's going to be pros, then obviously there's going to be cons. So what are the cons for hard money loans? So hard money loans do come with higher interest rates than they would for other types of investment property loans. There's short repayment periods. So investors need to acquire the property, do the work quickly, and then refinance or sell so they pay off the hard money loan before they're hit with late fees and overages. The asset is being used as collateral. So if the borrower defaults on the loan, then the first thing that's going to happen is that the lender is going to take away their property. And as we mentioned, predatory lenders. These days, there's a lot of lenders out there online. It's hard for investors and for brokers to know which lenders they can trust and which lenders are just going to rip them off. So by providing valuable insights, mitigating risks, and facilitating appropriate financing options, brokers can enhance their reputation, build solid long-term relationships with their clients, and really establish themselves as experts in this space. Hard money loans are primarily used by investors who want to fix and flip a property or who are following the BRRRR model. And you can get more information on the BRRRR model by joining my program. I'll link it in the description below. Subscribe and hit that like button, and I'll see you in the next video.